Andrew, we have a problem.
What's wrong, honey?
My car is getting old and I don't have life insurance. What if I get into a car accident?
You think you got issues? I can't decide which job offer to take.
We also haven't started saving for our children's education plans.
Do you think we should start funding an RESP or a TFSA just in case?
But we have no experience with financial planning. What do we do?
Wait a second, I have some friends that work at Wealthy Ones, a financial planning firm.
Great, can you call them?
Definitely. Hi Andrew and Kathy, welcome to our headquarters and thank you again for picking Wealthy Ones LLP for your financial planning needs. My name is Jonathan and these are my colleagues Karen, Sheshav, and Tommy. Today we'll take a quick look at your current financial position. Then we'll move on to our recommendations regarding key financial decisions. And lastly, we'll take a look at what your financial position should look like if you take our advice 5 years from now. Starting off with your current financial position, we were able to estimate your current net worth based off of the information you had given us in last week's meeting. Starting with your total assets, we believe they're worth around $466,000. And this of course includes your condo unit, your HISA account, your cash, and your cars. Moving on to your liabilities, we believe they are currently worth around $202,000, and this is mostly made up of the mortgage you have on your house. Therefore, your current net worth is around $264,000. This implies a debt ratio of 43%. While we do believe this is okay for now, we do believe we can improve it through our recommendations.
To start, we will go over your career and car options. For Andrew's job, we recommend you to go with the second job offer of the customer sales representative for the startup, since it offers more flexible working hours, allowing you to stay at home to take care of the children instead of spending additional money on childcare services. Moreover, we believe that there is a higher career growth potential compared to working for the government, since there are more opportunities to take on unique roles at a startup company. Although there is more risk with the foundation of a startup, we believe that Andrew will make significant strides towards the development of his skills. And lastly, the option to participate in a defined contribution pension plan will allow you to take control over your own investment decisions and make transferring assets simpler. All contributions and investment earnings made to your defined contribution pension plan are tax deductible, which will therefore lower your taxable income. On the other hand, the defined benefit plan limits the amount of withdrawals overall, and inflation can play a major role in adjusting in the future payouts. As for Kathy's car options, based on the information you provided us, we determined that a 5-year loan will keep monthly repayments under $500. However, the one downside is that the total interest paid will be greater compared to a 3-year and 4-year loan. We also went one step further and found a car that we believe your family should consider, which is a used 2018 Nissan Rogue. This is under Kathy's budget of $25,000, meets the needs as a family car, offers good interior space utilization, as well as safety features such as automatic emergency braking and blind spot monitors.
Now moving on to the condominium mortgage, good job noticing that the interest rates were declining. From the advertisement that you saw, the rate of 3.7 is very good compared to your current rate. However, that results in a monthly payment of $1,000.29. We recommend a better option as your current payment is quite high. We advise you move on to the 5-year fixed mortgage offered by Canwise Financial. With an experienced underwriting team and a certified mortgage broker, they have won 2018 and 2019 Canadian Mortgage Brokerage of the Year. Your current rate will drop from 4.9% to 2.79%, and your monthly payments drop from $1,390 to $925. While refinancing, not only does this reduce your interest rate, but it increases the pace at which you are building equity in your condo. Furthermore, we believe it will be a good idea to stay in your condo for a long period of time given the current real estate market conditions. Until your kids are old enough and you have settled into your long-term career paths, staying in this condo will be a good move. Therefore, refinancing to a shorter term loan with a shorter rate helps save for other expenses as well. The only major drawback for this is the $2,000 penalty fee, which we believe you can absorb right now given your financial condition, as it improves your long-term financial outlook. Now, as for life insurance, this is a vital step to ensure you have the support you need, especially during your retirement in case of any emergency. We recommend an SSQ insurance policy. SSQ is a company that specializes in individual insurance policies like these, and they are also a corporate leader in terms of environmental sustainability. This will be a 35-year term life insurance with an option of monthly payments of $44 or an annual payment of $484. Of course, we recommend the annual payment due to the cost savings. The total insurance policy will be $550,000 in coverage, and this will be $50,000 per year for 15 years and $330,000 during retirement support.
So moving on to your family's credit card loan situation, we calculated that if you continue to make minimum monthly payments, you would have an interest owed at the end of the year of $394.33. In terms of your HISA, we calculated that if you keep a balance of $2,000, you would have accumulated an interest of $46.49 for over a year's time. So one rule of thumb is to pay off all credit card loans immediately, and this can be financed with your HISA balance of $2,000. And we also recommend for you to increase your credit card limit from $10,000 to $20,000 since this will be useful for any emergency funding. So in general, we do recommend for you to avoid late payments, which will hurt credit card score.
As for the children's education plan, we advise your family to put the savings into the RESP over the TFSA and the high interest savings account. The advantages of a RESP include government will match 20% of your contributions, earnings in the plan is tax-free, and there is no annual contribution limit compared to the TFSA. Your family can put the $300 per month into the RESP plus an additional $117 in excess cash that we projected using the 5-year budget. As for the retirement plan, we estimated that your family will need about $500,000 by the time of your retirement to continue your current lifestyle. In order to reach this goal, you will need to save about $275 per month in TFSA at 7% rate of return. In addition, there is excess cash of about $225 per month to put into the TFSA. As requested by your family, here is a comparison of your children's education savings for the different savings methods. As you can see from the total savings, saving $500 a month at 6% rate of return will yield the highest total balance by the time the children is ready for post-secondary education. The interest earned also shows that the total balance is exponentially increases as you save more and at a higher return of investment. This is due to the power of compounding, which is why we recommend that your family save as soon as possible and as much as you can to take advantage of this effect.
Based off of all the recommendations we just made, we have made a list that prioritizes your financial goals. First and foremost, we want you to pay off your credit card loan balance, as the interest rate right now is just too high. Second, we want you to refinance your mortgage with a much friendlier interest rate. Third, we want you to purchase life insurance for Kathy, as she brings home most of the family's current disposable income. Fourth, we want you to replace Kathy's car with a 2018 Nissan Rogue. Fifth, we want you to fund an RESP, as that is what you will be mostly using in order to pay for your children's future tuition. And last but not least, we want you to put all your excess cash savings into a TFSA account, which will help with retirement.
Shown on the screen is your family's 5-year projected budget. The major assumptions we made include a 3% yearly increase in salaries, as well as a 2% inflation rate, which affects some expenses. The major expenses include household expenses, loan repayments, and living expenses. In the end, we had excess cash flow on hand, and we recommend your family to invest this cash into an RRSP until we reach the maximum contributions.
After 5 years, we believe your family's net worth will be $461,000. Your monetary assets will primarily include the joint checking account, since we did recommend not using the HISA going forward. As for your debt, this will mainly be the condo mortgage that we recommended with Canwise Financial with a 5-year term fixed mortgage, and we are assuming you will make your monthly mortgage payments. As for the other assets, the RRSP, the TFSA, and the RSP will now be included, as you will be making continuing investments through your income. Kathy's new car is valued at $13,600 after accounting for the standard depreciation and wear and tear of the Nissan Rogue after 5 years. For the insurance policy, we calculated to be about $700 by multiplying the present value of the payout by the probability of an average 35-year-old female's death.
That's all the time we have for today. Thank you for listening to our presentation, and we hope to do business with you soon again.